Hi, I'm Daryl Jones, Director of Research at Hedgeye Risk Management. I'm joined today on the phone by my colleague Hisham Shaban, who runs our Internet Research Group. Today we're going to talk about Internet technology and whether there's an emerging bubble given some of the recent transactions and also recent IPOs in the space. But to start off, Hisham, let's go to our best ideas list. You recently recommended to subscribers that they cover Twitter if they're short. We took it off our best ideas list as a short. What's changed there, and how does that view sort of reflect your broader view on the industry?
Well, in terms of Twitter, it was, our view on Twitter was very specific to Twitter, not social media in general.
Okay.
And the reason why we covered was simply because we saw upside to the first quarter of this year. We always saw upside ever since we went out on it. However, following the recent sell-off on the stock on its last earnings release, the setup has shifted. So we're really just risk managing the position. Our fundamental view hasn't changed. We're still expecting things to get a little dicey in the back half of 2014, more so in 2015. We're just looking for a better entry point on the short side.
Okay.
We're thinking that'll happen after the 1Q print.
Now, I guess the second question is a more broad one. Are there any signs to you that we're reaching sort of bubble levels in, technology, social media, or any of these sort of emerging tech companies have come public recently?
Yeah, I definitely think that we're showing signs of a bubble. I mean, with the recent string of IPOs, Zuckerberg's lofty acquisitions. I mean, there are definitely signs that is occurring. The question is not necessarily whether we're in a bubble, it's whether this bubble's going to pop, and when that's going to happen. My view there is that it's really hard to make the case for that. Right now, the difference this time around is that you have these larger players out there, Apple, Google, Facebook, for example, who are struggling to find their next growth driver, and they're all flush with cash. So, what will sustain this bubble in the near term are these larger players who are looking for their next growth driver.
Yeah, no, that totally makes sense. I guess one counterpoint today might be the Candy Crush IPO, down about 15%. Do you see that as the beginning of a sentiment shift? And have you seen other things that have kind of concerned you in terms of sentiment shifting? Because the reality is a lot of these companies aren't actually trading on fundamentals or valuation. To your point, it's all really about sentiment at this point.
Yeah, I mean that's really the best way to frame up the debate. It really is all sentiment. And with King, for example, I mean the reason why it's not living up to expectations today, in my opinion, really comes down to Zing. I mean, that stock soared on its IPO into the mid-teens range, and has sold off since, and it's basically a penny stock from here. So I think a lot of investors right now are connecting the two and are a little hesitant to go all in on King.
Got you. That makes sense. I get, now just to wrap up here, we've talked about sort of bubbles and why these companies might be at risk, but let's take the other side of the equation, which is, are there any business models that you actually like, broadly in the social media internet space, where even if they're slightly overvalued, there's a price where you'd consider going long?
Right. I mean, social media in general is seeing a migration of ad dollars flowing their way. I mean, that part is known. That part isn't really up for debate. The question is where do you want exposure? And I wouldn't say it's more about the business model as it is about the structure. And it's really, are you a takeout candidate or are you an acquirer, right? So where I would be seeking long leverage if I had to was more in the small to mid cap space versus the larger space. Because at the end of the day, if Zuckerberg wants to use his equity to acquire everything that's out there, eventually they're going to dilute the stock considerably. So where you don't want exposure is on the larger cap side of the equation. You'd want exposure on the smaller cap side because if they have a defensible business model, they're very likely to be taken out.
Great. Yeah, that makes a lot of sense, Hisham. I guess so. Just to conclude, we are concerned, about the sort of lofty valuations, the high multiples paid in recent acquisitions, particularly the Facebook acquisition yesterday. But the caveat to that is, a lot of this market's being driven by sentiment, and sentiment's a really hard thing to turn, or to pick when it's going to turn. So our view is, some of these companies may have good business models, but if you want to play the sector, you actually want to play the smaller companies that maybe get taken out by Google, Facebook, or even a Twitter, who has a pretty lofty market cap as well. If you have any questions for Hisham, feel free to tweet him at Hedgeye Internet. Thanks.